Joining me right now is Jeffrey Sherman. He is DoubleLine Deputy Chief Investment Officer. Jeff, it's good to see you.
Nice
Thank you so much for joining us. What do you think about that? How reliant do you see stocks are right now for what's coming out of Washington, for that tax policy?
Right. Well, I mean, as you mentioned, since Election Day, I mean, the stocks have been on a tear, and specifically in those sectors that should benefit from the reforms and the regulatory relief that people are expecting in the marketplace. However, some of that optimism waned over the last couple of months as there's been more divisiveness through Congress and the inability to affect some of these policies. And so I think we're at a pivotal point right now with the health care bill in the Senate, which everybody's discussing right now. And this is kind of a telltale moment on whether or not the administration can actually get one of the key points that they ran the platform on.
But you've got to, operate your business regardless, right? You've got to allocate capital.
That's right.
You're running, among others, the smart beta strategy.
Yeah, it's been
congratulations.
Yeah, thank you. It's been a very successful product, and it's systematic. So what we're trying to do is allocate capital through the cheapest sectors of the market. It focuses on sector risk.
So you're really looking for value.
Looking for value, and that's very important to long-term investors, right? We're talking about elevated valuation perhaps in the U.S. stock market. So if one needs to stay invested, which we always advise our clients to do so, the best way to do it is to try to buy the cheaper parts of the market, of course. Another thing that we favored this year as a trend coming into 2017 is allocating a little bit of capital away from the U.S. market. A lot of people are very overweight the U.S. market. It's been one of the best performing sectors of the global equity markets, and Europe does look a lot cheaper. We know that there's been some tension as reasons, but there's a lot of productivity increases on that side. And there's a lot of tailwinds on that side. Yes, there are some problems geopolitically, but that's the case everywhere.
All right, so you would rather put more money in Europe than the U.S., or you want to have both?
You want to own both. Definitely,
yeah.
You need to own both. But from a perspective of valuation and just the metrics, Europe does look a little more attractive today. So what we find is a lot of investors tend to be over-allocated to the U.S. relative to kind of global benchmarks or just essentially global GDP. The U.S. economy is 25% of global GDP approximately. But it's about 55% of the global equity market. And so from a perspective of opportunity set, we think the international markets are starting to look much more attractive, and you're starting to get some tailwinds from the political side as well.
And let's not forget, they have easy money there.
That's right.
They're still with the stimulus packages in Europe, where we're actually seeing rates go higher. Kevin Kelly's with me today, and he just said, look, how is DoubleLine handling bonds right now, given the fact that the Fed is raising rates? What's your take on bonds?
Right.
It's
been very interesting. As the Fed started this tightening cycle or raising interest rates on the front end of the curve, the bond market's actually rallied on the back end of the curve. So the curve is flattened, as we say, in the bond world. And what that portends some problems over the long run, but a lot of it is really driven by the inflation data that's come out. So although the Fed has been on this hiking regime, and they've hiked 3 times in the last 6.5 months, what you actually see here is that from the perspective of the inflation data, that's not going to be supportive going forward in the next couple of months. So something has to change in the underlying fundamental data for the Fed to continue to be this tightening regime. It was interesting that they started to announce this balance sheet reduction from all the stimulus they did from post-financial crisis.
Yeah.
But the bond market thought it was a snooze fest. I mean, yields did not really move. They moved down significantly the morning of the Fed meeting, but that was simply on the inflation print. As the inflation data continues to disappoint, and we look structurally inside of some of the components, it's likely that the inflation data will not be completely supportive of a Fed hike in the near future.
Okay.
So the bond market's pricing about a 45 to 55% chance of one additional rate hike this year, which is kind of in lockstep with the Fed's communication policy.
You agree with that?
I think the probability is right, but in order for the Fed to be able to raise, I think they have to have a pivot point or a turn in inflation and upward trajectory, and the trend is definitely not their friend.
Real quick, your colleague, obviously Jeffrey Gundlach, was one of the few out there who stuck his neck out around the election and said, I think Donald Trump will win, become president. Obviously, he was right. He invested around that. Are you worried that we seem to have these 4 senators now pushing back on the health care plan? And we know that that's critical to the rest of the agenda.
Yeah, I don't know if it's a complete concern right now. We try not to invest politically. Obviously, it isn't a big impact in the market today. However, if these 4 senators do block the health care reform bill, it doesn't bode well for Trump's agenda.
It's a problem.
It is a problem. And so the idea was the art of the deal. I kept hearing that phrase on the previous segment.
Right.
And what you're seeing is the deal making's not coming through right now. And financial markets still believe it. The bond market doesn't believe it as much as the equity market today. But the equity market, it needs to justify the valuation. So if you don't get the Trump agenda through, earnings need to catch up to kind of some of these price levels. So there is a lot riding on it today, and it is definitely a harbinger of how the policy works for the range of the year.
Yeah, great analysis there. Jeffrey, it's good to see you.
Great to see you as well,
Thank
Maria.
you so
Thanks
much
for
for
having me.
joining us. Jeffrey Sherman joining us there.